And that's what we are trying to show you guys, that we're not sitting there saying we don't believe in growth. We're sitting there saying, okay, what's that growth worth? One of the biggest misconceptions about value investors is they don't understand growth. Mo, how often do people look at us and say, you don't get the growth story here?
A lot.
Okay.
Because we don't understand 200% growth for 15 years in a row.
Well, it's not even that. What we see in the markets out there is we see a company growing and everybody just massively buying it, which makes the stock go up. And they say, look, it's all justified.
Yeah. And it's funny, we're going to get to the software, but three of our main metrics are revenue growth, net income growth, free cash flow growth.
We absolutely believe in growth.
Growth is a key part of investing.
Growth is how you can absolutely compound on yourself and buy a great company. In fact, when we see companies that don't have growth, we actually cut their price to earnings ratio and price to free cash flow. Because if you're not going to grow, I got to get my money through dividends and paying down debt and buybacks. So it's not going to be able to compound as easily. I got to get a discount for that. So the first thing, and by the way, my initial start as a value investor was not caring about growth. I did not. And then I started to realize, no, growth is important. So what do value investors do? They believe in something called intrinsic value. So what's intrinsic value? Basically, it's what you think a company is worth. Now, Warren Buffett and Charlie Munger talk about Berkshire Hathaway. And Buffett said, if you ask Charlie and I to come up with the intrinsic value for Berkshire, they're like, it'd be different. Probably be around the same number, but it'd be different. Mo and I all the time do stocks together. And guess what? We come up with different numbers.
Yeah, they're in the same ballpark, but...
Darnell always calls me and goes, your number's always higher than mine, Paul. And I said, good, good. Be cautious. Don't chase mine. However, remember one thing. This is what I always talk about. Let's talk about company A and company B. And let's say company A makes $1, then $2, then $3, then $4 forever. Company B does $1 a year forever. Which one are you going to pay more money for? Boom. If you don't see that we believe in growth, I absolutely will pay. If I go off 1 year, they're the same company.
The same exact company.
But the 1 year doesn't matter. If this one's growing, if it's got more growth potential, if it's got more opportunities for investment, I would absolutely have to pay more money for this one. Absolutely. Now, here's what happens, though. People will sit there and say, I'll pay $5 hypothetically. And people will say, I'll pay $20. Then they see it goes from $20 to $25, then $30. And what they do is they go, well, it's growing. Therefore, I'll pay more. When the market goes up and up and up, you're buying the growth. Well, guys, eventually growth stops.
Or slows, extremely slows.
Correct. Because guess what? If a company, look at Tesla. We've always said Tesla, to justify its current value, it's fallen a ton, but it essentially had to sell like tens, every single car in the world would have to be a Tesla car. This car company would account for every single car sold on the planet. And that's what we are trying to show you guys, that we're not sitting there saying we don't believe in growth. We're sitting there saying, okay, what's that growth worth? That's it. Now, if that makes sense to you guys, I really encourage you to subscribe to the channel, because this is the crux to value investing. It's about saying growth is awesome, but I can't overpay for growth. The analogy I always give is, this is the best cell phone out there, iPhone 14. Would you pay $2,000 for it?
Sure. I mean, if it's worth $2,000, let's see.
Would you pay $1 million for
No.
it? Would you pay $100 for it?
I'd buy 5,000 of them.
Exactly. That's what value investing is all about. We separate the price from the item. We sit there and say, this is a great phone. It is probably maybe the best phone on the market out there, but what price? You might sit there and say, well, Paul, it's a phone, it's different. No, it's not. It's no different. When you buy an investment, you're buying a future stream of cash flows. That cash flow on that phone might be 0,000,000. But the point is, you're buying some stream of cash flow. Our job as value investors is to value that cash flow. And we factor things in. Okay, what are the chances they hit that level? What are the chances they miss? What happens along the way if they take on more debt? We have to factor all those things in there, and we come up with a range. So let me show you guys. Let's just pull up a very simple company like Google. Our stock analyzer tool. Very first line, revenue growth percentage. Very first line. Not the last line, not the third line, not the, hey, don't worry about it. Very first line. Where do you see anything here about the balance sheet?
Nothing.
Nothing about the balance sheet. Now, people think Ben Graham was a balance sheet investor, and for a part of it, he was. Okay, where can I buy more assets than there are, blah, 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 et cetera, et cetera. But that's not what we're trying to do here. We're trying to teach a method here that looks at compounding money over long periods of time. The hardest part about that is the emotional mindset part.
Yeah. To be able to be confident in your numbers and stick with them through the troughs. I mean, Google right now is at $88 a share. That's rough, thinking that Google was coming from its darling high of, what was its high? $151.55. That's a big fall.
It is a big fall. Look at this big fall today. I texted you guys last night. I said, guys, Southwest Airlines, they're having problems. How excited was I, Mo?
Yeah, 6% almost.
It was over at 6% at one point today.
Wow.
So this is the kind of company where I sat there and said, wait, this is Southwest. They're having some temporary issues. I don't know how temporary those could be. It could make the stock. But to me, this is the opportunity I want. Why? Because people are taking a small short-term problem and extrapolating it out forever. So the same thing that happens when people over-exaggerate the positive, they're going to over-exaggerate the negative. And last night I said to my brother and Mo, I said, look at Southwest. They're going to fall hard. And I was so excited. I sold puts today at lower prices with higher premium because I look at it going, hell, I hope Southwest goes to $15 a share. Gladly. My goal as a value investor is for people to get negative opinions about the short run and take the short run problems and extrapolate them out forever. And that's what's great about value investing. When you see people take the short-term positives and extrapolate those out forever, the same happens on the reverse, the flip side. And that's our goal. And trust me, you guys are watching this and a large chunk of you are saying, that actually makes sense. And I know it can be difficult to translate that in investing. It's a process. I was the same way. I still remember asking questions back in the late 90s about, yeah, but how do you value a company? If I had heard me say that today, I'd have been like, that kid's going to be a value investor. Mm-hmm. But I still had a lot of emotional growth to do to be able to cheer this on. Especially if I own shares in this, which I do not currently. But if I own shares in this,
that's a hard thing to look at.
Right. Look at my Meta stock. I'm down 41% on Meta. I'm down 40% on Baba or 35% on Alibaba. It's hard to sit there and see it go down and go, I'm okay with this.
Yeah.
That's the hard part about investing. But when it comes to growth, the absolute first thing we look at is, and for value investing, is what's the growth going to be? Because if I can find a company that's going to grow, and look at it this way. Let's do the numbers right here, Mo.
What are we going to do, Southwest?
Yeah.
Okay.
I just did it this morning, actually. So I'm going to go ahead and put it in there. Let's see where it is. Mo's doing his. Here's proof right here, guys. As my growth level increased, so does my value. That's it. Very simple. My low price is here, $27. My high price is $48. My middle price is $36. And I have 12, 14, and 16% desired return. And Mo, I already see his numbers. He's, again, going to be lower than mine.
There we go. $16 to $33.
So here's what he did different. The last 5 years have been affected by COVID. Mm-hmm. He extrapolated out more. I just sat there and said, that was a fluke. Okay. I'm okay doing 369. Say it.
369.
Damn, you're fine. 6, 7, 8%. What'd you do for your PE?
13, 15, 17.
I did 14, 16, 18. Did I return?
12, 14, 16.
So did I. So Mo and I came up with different numbers. Mo's sitting there going like, oh, look at Mo's numbers. His high side is 33. My low side and middle side are okay. Who's right? I don't know. I did a 20-year analysis, I think.
I did 10.
No, I did 10-year analysis. Okay. If I go to 20 years, oh my God, look how much better it gets. Look at this. I have a 25 on the low side, 46 on the high, 35. It's actually a little bit lower. Sorry. Okay. So guys, again, if this makes sense to you and you realize that the narrative being said about us not understanding growth is incorrect, subscribe to the channel, watch our videos. We have almost 2,000 videos in the channel. You'll get a lot of value from it. If you like the software and you want to use this, we had over 1.2 million times this year. People use our stock analyzer tool. Go to everythingmoney.com. No risk. Sign up for a month. If you don't like it, money back guarantee. Thank you for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?